The Secure Act, the original Secure Act, now I'm told by some younger people, I've been doing programs, and they say, when you talk about original Secure Act, call it the OG, and you'll sound really hip. So whatever that means. So the OG Secure Act from 2020, that was transformational.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm Dean Barber, founder and CEO of Barber Financial Group and your host of the Guided Retirement Show. Joining me again, Ed Slott. He is considered by the Wall Street Journal to be America's IRA expert. I've been studying personally with Ed for almost 20 years now, and he is a wealth of information. And today we're going to talk about the Secure Act 2.0. Please enjoy my conversation with Ed Slott. All right, my good friend Ed Slott back with us here on the Guided Retirement Show. Ed, how are you doing?
Well, great to be back. Great to be here in a new year with new tax rules, and everybody's wondering, how do these things affect me? What are they doing in Congress anyway?
Well, I don't know if we want to even talk about Congress right now. Right. It's kind of an embarrassment, but
that's where it begins.
Yeah, they did some good things in the Secure Act 2.0, Ed, and I'd like to have our listeners and viewers really understand what the Secure Act 2.0 is. And for anybody that doesn't know what the Secure Act is, there's another podcast that Ed and I did on the Secure Act, and you can find that in a link here in the show notes. But Ed, let's talk about Secure 2.0. What was the big objective here?
Well, let's go back. Even though they can go back to the other show, you have to look at it as a frame of reference of where we came from. The Secure Act, the original Secure Act, now I'm told by some younger people, I've been doing programs, and they say, when you talk about original Secure Act, call it the OG, and you'll sound really hip. So whatever that means. So the OG Secure Act from 2020, that was transformational. That was a game changer. That changed the plans most people had for 20, 30 years for their 401ks, for their IRAs, leaving it to children or grandchildren who were able to stretch or extend deferrals on their inherited IRAs and Roths for 20, 30, 50, 80 years if you had a young grandchild. Congress didn't like that. And in the original Secure Act, which has been effective now since 2020, that was eliminated and replaced with a very complicated 10-year rule. That changed the planning for everybody. In fact, if you're watching this, you might say, I wonder if my plan that I originally had is even going to hold up anymore. Probably not. If you haven't had it at a minimum reviewed and probably revised or scrapped altogether with a new, better plan.
Well, and Ed, I think that everybody that's watching or listening here needs to understand that the Secure Act, the original Secure Act, affects anybody who has an IRA or 401k or might inherit an IRA or 401k. So it's not just the people that are thinking about passing it down that really need to be aware of it. It's people that will stand to inherit a IRA or a 401k plan. That is where the real rubber meets the road, and that's what changed.
Yeah, that's the big change. And the big change, like I said, for most beneficiaries, all of the money when they inherit will have to come out at the end of the 10th year after death. So what did that do? That put an end date. That put a finite end date when all this money has to come out. So if you look at it, it's like they shorten the window. When you shorten the window, when all the money has to come out, I mean, you have a tax problem. Look what happens like a fire hose. You know what I mean? If you have a wide window, it drip, 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 drip. But when you shorten that hose, a blast comes out. And that's what you're going to have. That's what's in effect now. And when a lot of money has to come out through a short opening, a short window, taxes, even if they stay at the current rates, are going to hit, and more money is going to be lost to taxes. So that's what happened with the Secure Act. Then it got so complicated, IRS had to write regulations, making even more complicated, because now it turned out some beneficiaries had RMDs, required minimum distributions, during those 10 years if they inherited from somebody who already started taking RMDs. And then IRS had to come out with relief to say, all right, we made it a little more complicated. Now we're going to give relief, but only to some people. And that created more confusion. And then comes the last day of the year, talking about if not for the last minute, nothing would ever get done. December 29th, 2022. We have Secure 2.0 being enacted and effective a couple of days later. But Congress really played games with us on this one. Now, this wasn't the game changer, Secure, the original Secure one, but it was overhyped in the media. So a lot of people watching here saw all the stories, the headlines, because it was something to write about, because Secure 2.0 was part of a 4,100 page omnibus bill. But the Secure part was still about 350 pages of that, with over 90 provisions affecting retirement accounts. So everybody wanted to know, is there something in it for me? Are there goodies? What should I know about? So that's what we have now. And Congress really made it complex because I don't know what the reason is. Probably budgetary constraints over 10 years. But the effective dates are all over the place. So when we talk about things, some are effective now. Some are effective even retroactively before 23. Some are effective in 24. Some are not effective for 10 years. So as you know, as a member of our elite IRA advisor group, we actually gave you a cheat sheet, a list of effective dates. So when you're talking to clients, you say, okay, that one's in, let me see, 24. Oh, that one's in 25. This one, 26. I mean, it's crazy. It used to be, Dean, I go back a long time with tax law, when a bill was signed into law, enacted, it used to be everything was effective on the date of enactment. But now we have all these, I have to just believe it's all these budget gimmicks. So here are the big parts of Secure 2.0 that people should know about. Number one, it wasn't the big game changer that Secure was. It was trimming around the edges, nothing earth-shattering, but a lot of little provisions. Another big part of it, Congress went back to loving Roth IRAs. Why did they love Roth IRAs at Secure 2.0? As usual, you know why they love Roth IRAs. It brings in money.
They can get more money
to pay
now
for all the other stuff. And they don't even hide it anymore. Let me see if I can get you this thing. I have the whole bill here. Let me see if I have this here. Yep, I have it marked. Here's part of the bill. They don't even hide it anymore. I don't know. They tell you they're using Roths to create revenue. They used to hide it. I don't know if you could see this. I have it marked. This is one of the sections of the Secure 2.0. You see how big that type is?
Yes.
What does it say? Revenue provisions, right?
That's it. That? Roth IRAs. Yes.
That's where all the Roth stuff is. They don't even hide it. Revenue provisions in that giant, you know what I call that type? Men walk on moon type. That's what, when I was a kid, that was the largest type, July something, maybe 20th, 1969. The men walked on the moon, Neil Armstrong and all that. And they said the headlines in the New York Times were the largest font ever printed. I don't know if that's still true to today, but so they referred to it over the years as Men Walk on Moon font. That's how big that font was. Revenue provision. So they're not even hiding it. So Congress in Secure 2.0 loves Roth IRAs because it brings in money. The only money that can get into a Roth IRA or Roth 401k is already taxed money, and people like it. So why don't we take advantage of Congress? And here's what I mean. Why do they put that in? Because they're the worst financial planners on earth. They're so short-sighted, they just get all the money up front. They only look at 10-year budget cycles. So they think this is great. Look at all the money it's going to bring in. They want more people going to Roth 401ks. So you might ask, how does that bring in money? Well, if you're an employee and you put money in your 401k, you get a deduction, not on your tax return, but you get a deduction. Your W-2 shows less based on that contribution. So you pay tax on less money. For example, if you make $50,000 and you put $5,000 in your 401k, your W-2 will only show you as income for $45,000. If you instead go to a Roth 401k, you'll still have the contribution, but you will pay tax on the full 50. This is why Congress likes Roths, because when people don't take deductions, that's the same thing as generating revenue. But I think it's a great thing. Tax rates are very low now, and the fact that look what Congress is doing, all these provisions and the revenue provisions of Secure 2.0, Roth SEP IRA, we never had that before, Roth Simple IRAs, Roth matching contributions, Roth catch-up contributions. They want Roth everywhere because they need the money. So why not take advantage of that? So there's plenty of opportunity in those provisions to dump more money in Roths, and this is great to do while tax rates are low. If you believe, like I do, that tax rates are in the future will have to go higher. Look, we know what they are for these next 3 years: 23, 24, and 25. After 25, they're supposed to go back to those old levels, which is a tax increase. So this is the perfect time to load up on Roths. If you believe, like I do, that future tax rates will be higher, the Roth is a good bet. So that's a big part of Secure 2.0. Helping people get more money into Roths, or encouraging people to put more money into Roths, because Congress needs money, but it's good for us too.
Yeah, Ed, let's talk a little bit deeper about the provision that allows employers to make a match into the Roth portion of the 401k, because prior to Secure Act 2.0, if an employee was putting money into the Roth portion of their 401k, the employer match was forced into the traditional part of the 401k. So
no, not anymore now.
But not anymore.
This is a great improvement. That's what I said.
So what does that do to the employer? What does that do to the employer?
Well, the employer still puts the money in, so they still get a deduction, obviously, for it. But they get a deduction. But the person, the employee, gets that money into a Roth. They don't get a deduction like they would if they, did a regular 401k.
Yeah. Okay, so the employer still does get the deduction, and so you think most employers...
Well, I don't think it's clear in the law, but I think it's true, because if they're paying out, if I'm a business paying out, even if it goes to a Roth, that should be a deductible item.
But I don't think the Secure Act 2.0 made that clear, did it?
I don't know if it made it clear either. And, that's another thing. This was jammed through at the last minute, so we have to wait for IRS to write regulations and give us examples on exactly how these rules work. There's something in all these provisions that, have questions, open questions. But the big point is there's more opportunity to stuff money at work in Roth plans and catch-up contributions. In fact, there's one provision where catch-up contributions can go to your Roth 401k, and if your income, your wages from that company are more than $145,000, it must go to the Roth. They make it sound like it's a bad thing because they don't want people getting deductions. They want revenue. So this is great all around. So I think that's a big part of Secure 2.0.
Don't you think it'll be a while before the employers are able to get that provision written into their plan documents? I'd say a couple of years probably. Maybe someone would get there.
Effective till 2024, most of that. So that's why it'll take them a while. The SEP and simple Roth IRAs are effective now, but you're right. Practically speaking, almost no institution's going to have the forms ready. Again, if the law was passed December 29th, the big institutions, the Fidelities, Vanguards, they're not going to be able to offer SEP Roth IRAs and simple Roth IRAs yet. They take them a while to put their paperwork together.
Yeah, now for sure. So the other thing that I think that was good about the Secure Act 2.0 was the increased limits on what people can put into their SEP, their simple, their 401k, their IRA, their Roth IRA.
Yeah, that's all good too, without getting into specifics. Anytime you can put more money away, and that was one of the overall themes, the ability to put more money away, catch-up contributions, a crazy provision for only people 60, 61, and 62, and 63. I don't know where they came. Again, must be budget guidelines or something, but you could put a lot more money away. Now, this is good for people who have the disposable income, and maybe it would encourage more people to dump more in. The more you can get into any kind of Roth vehicle, the more you're going to have a hedge against the uncertainty of what future higher taxes can do to you in retirement. If you believe, like me, taxes are headed up. When I ask, this is funny, Dean, when I ask people in seminars, Do you think your tax rates will go up? Because I talk about the deficits, the debt, the math. And many people, only half the people will raise their hands because they're in this belief that in retirement, their rate should actually go down, which you and I know rarely happens. Because if you don't do anything, your RMDs can be higher than your best years working. Plus, you don't have the deductions you had when you were working.
Right. And another thing I don't think people think about often enough, Ed, is when you're doing a tax return married filing jointly,
right,
to hit the brackets where the tax rates are higher, you have to have a lot more income. But as soon as one spouse passes away in retirement, that surviving spouse is automatically going to be in a higher tax bracket because the income's likely not going to decline very much. But the tax brackets are much smaller, much lower. You hit the higher tax brackets as a single taxpayer. That's another reason why I love the Roth IRA, because not only do you get tax-free income, you're not going to get pushed up into another limit. And the Roth IRA income doesn't cause any of your Social Security to become taxable either.
Right. And it's very important. That's a very big point. I've been calling it, as you know, for years, the widow's tax, the widow's penalty, whatever you want to call it. When one spouse dies, the other spouse, as you say, will be filing single. So it's good to use these 3 years of historic low rates. And everybody complains about inflation. But when it comes to tax planning, it's great. The biggest increase we've ever had, expanding the brackets. The rates are the same, but more income, like for Roth conversions, can pass through these brackets. So there's more opportunity to move to tax-free Roths for at least 3 years, 23, 24, and 25. Another key point of the Secure 2.0 that had a lot of people misunderstanding because they only read the headlines. When it came out, the RMD age I'm talking about was raised 73 to 75. So when the law came out, I saw headlines, RMD age raised to 75. That doesn't happen for 10 years. So forget about that. But it does go to 73 now, but not for everybody. If you were already taking RMDs, you don't get a chance to stop and start. They never let you stop. The IRS and Congress look at RMDs as a water faucet. Once they're started, you can't stop. There's no off switch. So once you're started, you're into the system. But 73, all right, so it gives you one more year of freedom to do more things before you're constrained with RMDs, like a Roth conversion. For example, you should be looking at taking advantage of these next 3 years to get as much out at these low rates and expanded brackets before RMDs begin. If you're not already there, it doesn't mean you can't convert once RMDs begin, but they cost more because the RMD itself has to be taken, and that cannot be converted. So you must first satisfy the RMD, pay tax on that, and then if you want to convert any part of the remaining balance, you can, but it costs more because you had to first take the RMD. So let's say you're in your 60s, maybe that's a good sweet spot. Start getting that money down and bringing your IRA balance down. Then maybe when you start RMDs, and if tax rates are higher too, which it could be, your RMDs could be lower because remember, with a Roth IRA, once the funds are in there, they're tax-free. Plus, there's no lifetime requirement to take distributions. Not only that, for your life, for the rest of your life, you never have to touch it. It keeps growing tax-free. And for 10 years after your death, the beneficiaries can hold on to an inherited Roth for 10 years. So there's benefits to the Roth. But the reason I point out the RMD age, people like that. Congress loves that because it's popular. Oh, look, we put off the pain till age 73. But I don't think it's a great provision, but I don't think you should be looking to defer as long as possible. But that's human nature. People see 73, good, I don't have to take it till 73. The M in RMD stands for minimum. It does not stand for maximum. You can always take more. I might even suggest have people look at doing conversions, getting money out before RMDs, like I was just saying, begin. Why wait till they have to come out? Now you have an opportunity to get money out at lower rates. Don't wait till 73 just because they push the age back.
Yeah, one of the things, Ed, I really love the Roth conversion as part of financial planning but there are some provisions that people need to be aware of, and one of them is the IRMA tax, which is increased in your Medicare premium. So you have to be aware when you're doing that conversion, how that conversion impacts other dividends, capital gains that might otherwise have some preferential tax treatment. They could also increase the amount of Social Security that's taxable and increase your Medicare premium. So when you're doing that, I think it's critical that before you start just converting, just because Ed says it's a great idea, I believe that you have to already have a good holistic financial plan done so that you can actually see the impact in dollars to your probability of success. And you'll see the impact as far as how much less tax you'll pay over your lifetime. And you'll see the impact of the additional money that you'll be able to spend in retirement. But I think that before people convert, Ed, they should have that financial plan done first. And that financial plan should be reviewed by a CPA from a tax perspective, looking at the Roth conversions.
Well, before you convert at all, you make a great point. You must have a projection of what the tax and the ripple effect, these stealth taxes like these IRMA charges will be. Because once you do a conversion, and this has been law for a few years already, it's permanent. There's no backsies, no do-overs. No, we used to call it recharacterizations. You wanted to undo it. You can't do it anymore. Roth conversions are permanent. Now, that should not deter you from doing a Roth conversion, but you should know once you convert, you will owe the tax, even if your financial situation changes when the bill comes due. It should not deter you, but you need a projection. You need to know exactly what Dean says, what it's going to cost. Now, about the Medicare charges, that's serious business, and it's very complicated to project because for two reasons. Number one, it's not a tax you see on the tax return, like the tax on Social Security. It's just billed. It's taken out of your Social Security, or some people pay it directly. So it's off the tax return. So you have to look at another document. The other thing is the cliff. It's called the cliff. What I mean, if you go $1 over some of these limits, these income limits, it can really lower the boom on you. And the other problem with it is that the 2-year look back. So it's hard to see, if it's not on a tax return, what it's going to cost, and it's a 2-year look back. So I always tell people, if you're really worried about that, get your conversions in before turning 63. Now, some people say, well, I'm not going to hit Medicare till 65, so I could do a conversion at 64. No, it's going to trigger 2 years later those IRMA charges for Parts B and D. If get conversions in at age 62 or earlier.
The other problem with those IRMA limits, Ed, is they're adjusted for inflation. And so it's a guess at what those IRMA limits are going to be. And like you were saying, if you go $1 over those IRMA limits, it's a 2-year look back, and then all of a sudden you might be paying several $100s more per year or even per month in Medicare Part B premiums.
Yeah, you're going to have an overall review, but I still like the idea of Roth conversions because over time, let's take an extreme case. If you take down all your IRA, I'm not saying to do that, but over time, maybe you can, and you have everything in a Roth, well, then you've solved the IRMA problem because anything you take out of the Roth in retirement is tax-free. I had a woman come up to me on exactly that point, the IRMA charges at a seminar I was doing, and I did the whole thing about how I love Roth because I love tax-free, and everybody loves tax-free. I mean, it's the best thing for a seminar. I don't care how polarized the country is. Nobody likes taxes. Everybody loves tax-free. So that if I was a candidate, I'm not, but my advice to a candidate, just talk tax-free. Everybody will love you. So she liked the idea of Roth conversions, but she asked the question, she stood up, I remember, says, all right, I like Roth conversions, but I'm on Medicare. I have those Parts B and D surcharges, those IRMA charges, income-related monthly adjustment amount. That's what that stands for. And she says, so if I understand you correctly, if I do a Roth conversion, my IRMA charges will increase, and that would make me angry. So I said to her, you know what? You make a good point. If that would make you angry, then convert anyway, because I'd rather have you be angry for 1 year than be angry for the rest of your life.
Yeah, exactly. Because if your RMDs are big enough, you could be in that permanent increased Medicare premium once your required minimum distributions start. So
So
you're
maybe
exactly
it
right.
pays sometimes to take a little of the pain. That's what the Roth is. There's some pain up front, but at low rates, it's not a bad investment. But as you said, you have to look at it holistically, like you say, in line with their whole tax projection, for because everybody's got their own different facts and circumstances and income levels. So this is really a customized item that you have to look at with an advisor that can do something like that, like you guys do, Dean.
Absolutely. Absolutely. It's something we look at every single year. And I think it's important when you're looking at doing Roth conversions that you don't wait until late in the year to determine if you want to do Roth conversions. You should be doing that planning early in the year so that you don't run up against a time clock.
Yeah, well, sometimes that's hard because what happens at the end of the year, a lot of times I tell people, wait, you could plan it out early, but don't, pull the trigger till close to the like after Thanksgiving, because even in big loss years like in 2022, people got surprised who did early Roth conversions on how much more it cost than they projected when they got all those mutual fund capital gain distributions.
Yeah, that phantom income from mutual funds is something that people really have to look at the end of each year, especially when you have a bad year followed by, or that was preceded by a couple of really good years where you might have some profit taking in there. You can have a fund that actually loses money in the year, but you had a capital gain distribution that you have to pay taxes on. And that could, again, mess up your Roth, and it could take you over that cliff for the Medicare premiums, all kinds of things.
Yeah.
If you hold mutual funds in a taxable account, whether it's an individual, joint, or trust account, you need to pay attention to those capital gain distributions. Generally, you'll get an idea sometime in November what those capital gain distributions will be so that you can make a determination if you need to sell that particular fund. And there's all kinds of tax planning that goes in to that at the end of each year as well, Ed. But ETFs are better to own in a taxable account than a mutual fund.
Yeah.
So what else do you want to talk about on the Secure Act, Ed? I mean, there's the increased limits, and then there's the Roth piece of it. There's the required minimum distribution piece.
Biggest items. A lot of the other items, there's a big section on getting money out early. They added a whole slew of penalty exceptions for taking your money out early out of an IRA or a 401k, all kinds of new exceptions. I get that. I mean, Congress uses all these terms that who would vote against? I mean, birth, adoption, domestic abuse, terminal illness, financial disaster. I mean, it's at the point.
But the amounts that can be taken out without penalty for all those things are minuscule.
They're kind of small, but the whole idea is, I get it. If you're up against the gun and it's your only money, it should be a last resort. People should look at this, because I saw articles on this already. Oh, a great way to get at your retirement savings before 59 and a half. Well, what are you going to have for retirement if you go through it now? It should be an absolute last resort. Even without the 10% penalty, you still have to pay the tax. I think that's what's lost in these things. All right, no 10% penalty, but you still have to pay the tax. So this is expensive money to fix a problem. But that's another big part of Secure 2.0. And if you have issues, I hope you don't, but there are some safety hatches in Secure 2.0, but they happen at all different levels, at all different years. Not all of them are effective immediately.
Right. And for all the good things that the Secure 2.0 did, Ed, they failed to address the most complex part of the original Secure Act, which is the non-eligible designated beneficiaries and the non-designated beneficiaries and eligible designated. I mean, they didn't fix any of that.
That really sticks in my side, because that book was open. The law was open. It could have taken one line to make it clear what is the deal with the 10-year rule. Are there RMDs for years 1 through 9 or not? They could have easily said what they intended. The fact that they punted on that and chose not to address it means they're okay with the IRS's interpretation, so that will probably be the rules. And I don't know why. They had to know. There was lots of complaints, lots of comments during the comment period. It was well known. This was ambiguous. The law was written poorly. We thought the 10-year rule was a clear 10 years without RMDs. All Congress did is make IRAs very difficult and complex to inherit. And they got their wish with Secure, going back to original Secure. They made IRAs a lousy asset for wealth transfer and estate planning. Roths are better. Life insurance is better. Indirectly, what they really did is incentivize us to do the better planning we should have been doing all along. IRAs, even under the old rules, were complicated to get out to beneficiaries because of all the rules, but at least they had the stretch IRA. With that it's lousy.
Yeah. It is, and I think that they're trying to make up for how complex they made the new rules for inheriting IRAs by reducing the amount of the penalty if you mess up that required minimum distribution on a beneficiary IRA. So let's talk a little bit about that, because they did reduce the penalty.
Don't get me started on that. I don't, maybe call me cynical. Yes, it was the harshest penalty in the tax code, at least in the retirement tax code, a 50% penalty for not taking a required minimum distribution. That was unbelievable. That's how it's been for decades, 50% penalty. So Secure 2.0 reduces that to 25% and now 10% if you make up the misdistribution. But here's the thing. It was so harsh, IRS was lenient in almost every case. I don't even recall if I ever saw anybody get hit with that penalty. IRS waived it in almost every case because they didn't want to hit people with that kind of draconian penalty. I mean, all you had to, the dog ate my homework, whatever. They waived the penalty because it was 50%. Now I wonder, with the penalty only 10%, are more people are they going to be as generous and lenient? I'd rather pay 50% of nothing than 10% of something. So we'll see how that develops.
I agree. Well, Ed, I want to remind everybody once again that they need to click the link in the show notes, because if they go back and watch our original podcast or listen to our original podcast on the Secure Act, that'll help put some context into the Secure 2.0. It is complex. Obviously, I'm looking forward to spending time with you and all of the other Master Elite members in we're Baltimore this year, end of April. So
National Harbor.
Yes.
If we yell out enough, they'll hear us in Congress. We're right across the bay.
Well, we'll make some noise for them then. Ed, thanks for taking time to join me here on the Guided Retirement Show. Have a great day.
All right. Thanks, Dean.
Thanks again for joining me on the Guided Retirement Show. Ed is always full of energy, and hard to get a word in edgewise with Ed all the time. Hope you enjoyed. Make sure that you subscribe to the Guided Retirement Show, share with your friends, and check out the links in the show notes for special information and the ability to meet with one of our certified financial planners who are also parts of Ed Slott's Elite IRA Advisor Group.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.